Hello, welcome back to Financial Management. So we're going to continue with our discussion of dividends. Before the midterm, we looked at dividends within a frictionless environment. And now what we're going to do is we're going to add some frictions. So we'll look to see what happens when in the real world, dividends basically can affect firm value. And we'll study why that is. So we'll examine dividend policy as a tool for signaling. We'll discuss taxes, asymmetric information, and agency problems. So Modigliani and Miller were the first to really discuss different frictions in capital markets that make dividends relevant. So the first is going to be taxes. And the main idea is that different shareholders have different tax preferences. We'll next look at asymmetric information, meaning that the dividend itself could be a signal for firm value, especially if, as an investor, I know less than the managers. And the last thing we'll look at are agency problems. And hopefully, this feels intuitive after the last problem set that you turned in which the manager could decide whether or not to take on a project that would be really risky for bondholders, but would be good for shareholders. So, more generally, we think of agency problems as the capacity for the manager to not act in our best interest as shareholders. And we'll look at the reasons why these market frictions make dividends important. So, our first will be taxes. Dividends and capital gains are typically taxed at different rates. A capital gain is the gain that you get from selling an asset that you've held for a year. So if you've bought a stock at 10, you sell it at 15 a year later, you've realized a capital gain of $5. Historically, dividends are taxed at higher rates than capital gains. And even when they're taxed at the same rate, the capital gain has the slight advantage that you realize the capital gain on paper, but you only pay the taxes for it when you sell it, which is much better than when we think about dividends, because dividends you're charged as soon as the dividend income comes in. So dividend and the relevance of dividends have been incredibly important in terms of economic policy and political changes. One of the takeaways that we can sort of use to figure out how important dividends are by looking at what happens around these changes. So hopefully what you can see on this slide is that from 2012 to 2013, there was going to be a 5% jump in the tax rate for dividends and a 5% jump in the tax rate for capital gains. So we can kind of use that as an example from the real world to see what firms were doing. This was referred to as the fiscal cliff. So this referred to the more than 500 billion tax increase that was going to go across the board for fiscal year 2013, unless then President Obama and the Republicans in Congress were able to basically come to terms. And as you can imagine, they weren't, which is why we saw the jump. So, in response to this projected fiscal cliff, Costco decided that it had to do something. So Costco, the warehouse merchant, announced Wednesday that it will pay a $3 billion dividend payment before year's end 2012, saving shareholders from a big bite should taxes rise due to the fiscal cliff. The company said that a $7 a share payment is possible due to strong balance sheet and its good access to capital. The payment will be in addition to the regular 27.5-cent a share dividend that would be paid on November 30. The special dividend will be paid on December 18th to shareholders of record on December 10th. That will allow investors to pay the lower rate of 15% currently in effect on dividends. With taxes set to rise on Jan 1 as part of the fiscal cliff, the rate paid on the dividend could more than double for many high-income taxpayers. So hopefully what we can learn from this example is that dividends do affect the way that firms behave. And a lot of that behavior operates through these tax implications. The fact that different investors have different tax preferences, such that even in the presence of them rising, we observe a company speeding up a large special dividend. Dividend relevance taxation. So differential tax treatments impact a manager's choice between dividends and share repurchases. If dividends are taxed at a higher rate than capital gains, a shareholder would prefer a share repurchase to dividends. And hopefully that makes intuitive sense. If I know that the money that you pay me in the dividend is going to be taxed at a higher rate, then I'm going to walk away with less money in my hand. So if I am an investor that is subject to a higher dividend tax rate, I would prefer a repurchase. Why? Because the repurchase is just like a capital gain. So dividends are taxed at the dividend tax rate. If a manager repurchases shares, the shareholder can sell some of those shares to create a homemade dividend, which will be taxed at the capital gains rate. We saw in our last slide, in our last lecture rather, how we were able to make a homemade dividend by simply selling off some of our shares. Historically, the capital gains rate has never been greater than the dividend tax rate. When the dividend tax rate exceeds the capital gains tax rate, the investor pays a higher tax bill if dividends are chosen over repurchases. And again, that should make intuitive sense. That is, if dividends are chosen, investors get a lower after-tax return and thus will demand a higher pre-tax return by demanding a lower price for those shares. What does that mean? It means that as an investor, I'm really concerned with my after-tax return. So if I know that part of the cost of capital calculation that I'm applying to the firm is their payout, and if the payout for me is going to be taxed at a higher rate, then the firm has to give me an even higher return. And the way that the firm will give me that higher return is it's going to lower the price. So I'll lower the price that I'm willing to pay for a share of the firm. Dividend relevance. By this reasoning, a firm should always choose share repurchases over dividends, as the capital gain tax rate is never greater than the dividend tax rate. However, in the real world, we see that firms have and still do issue dividends to investors. This is known as the dividend puzzle. Why are dividends still issued when they have a tax disadvantage relative to share repurchases? So we think of this as the dividend puzzle. It could have something to do with the fact that different firms have different investors. So, as an individual investor, about 52% of all investors are taxed at a higher rate on dividends. However, if those stocks are held in a retirement account, then there's no tax on those dividends or capital gains. Institutional investors and pension funds, which are responsible for about 47% of all investors, so roughly half, are subject to no taxes on dividends or capital gains. They may even prefer a steady stream of dividend payments if it matches their income needs. And corporations, which are responsible for about 1% of all investment, can exclude 70% of dividend income for taxation purposes, but cannot exclude any capital gain income. So hopefully it's intuitive that if firms have different types of investors, then they may have different preferences for dividends. So even though the dividend is going to be taxed at a higher rate, if a large portion of your investors are institutional investors or pension funds or other corporates, then the importance of the dividend tax may not really factor in. This implies the following investor preferences when only tax effects are considered. We would think that individuals would have a preference for share repurchases. Institutions would have no preference, though they might slightly prefer the steady dividend stream, because as we saw from our previous lecture, dividends are fairly sticky. And then corporations, which might have a preference for dividends. Keep in mind that a preference for dividends or capital gains can be influenced by other factors independent of tax. So let's look more closely at this tax. We can figure out numerically if an investor prefers dividends or share repurchases by calculating the effective dividend tax rate, denoted as tau star D. So whenever we see that cursive T, we'll call it tau D, tau star D. So what is this equation? We've got the dividend tax rate minus the capital gains tax rate divided by 1 minus the capital gains tax rate. This is how we can solve for the effective dividend tax rate. And this is going to measure how much less you receive in percentage terms from an after-tax dollar of dividends compared to an after-tax dollar of capital gains. So in percentage terms, it's letting me know how much less I make if you pay me through a dividend, or if you were to do a repurchase. Which would I prefer? Would I prefer the capital gain on a repurchase or the income through the dividend? If this number is positive, the investor prefers share repurchases. If it's negative, the investor prefers dividends. Also recall that in frictionless markets, the price per share drops by the dividend per share. And we saw that and worked those examples. When taxes are included, the price drops by the effective after-tax dividend. So we've got the price cum dividend minus the price x dividend, which is going to equal 1 minus tau star D, 1 minus the effective dividend tax rate multiplied by the dividend. So we can kind of make sense of this in an intuitive fashion. We know the price cum dividend. So in the examples we worked on before, let's say the firm has a price of $40 per share and they pay a dividend of $4. We would expect that the firm would then trade at $36 per share. But in the real world, when we look to this in the data, we'll notice that it doesn't perfectly fall by $4 per share. And this is what we're trying to get at here when we think about the effective tax rate for the dividend, trying to back that out given the X price after the firm has paid its dividend. Let's work through some numerical examples. An individual investor is subject to a 50% tax on dividends and a 25% tax on capital gains. The investor owns one share. How much does the investor receive for a $1 per share in capital gains? Hopefully this is very intuitive. We know that the investor is taxed at a rate of 25% on capital gains, so they'll only be receiving 75 cents of that dollar that they're promised in capital gain. How much does the investor receive for a dollar share in dividends? Again, hopefully this feels very intuitive. If I'm taxed at a rate of 50%, I'm only taking in 1 minus 50%. So I'm receiving only 50 cents of that dollar that I'm paid. What percentage less do you receive for the after-tax dividend versus the after-tax capital gain? When you look at the answer and you try to set this up, the way that we'll think of this is how much do I make when I'm paid and I'm subject to a capital gain tax? That's 75 cents. 75 cents multiplied by 1 minus something equals how much I make when I'm paid and I'm taxed on the dividend, the 50 cents. Why are we setting it up that way? We're setting it up that way because we want to know what percentage less do we receive for the after-tax dividend versus the after-tax capital gain. And then our last question, what is the effective tax rate for the investor? To solve for the effective tax rate for the investor, we can plug our numbers into our tau star D, our tax rate formula, very straightforward. Hopefully what we'll observe across both of these methods for the percentage and also the effective tax rate is that we end up with the same number. Example 2. The stock price of firm XYZ was $6.75 on 3/30/2018. The firm paid a dividend of $2 per share on 3/31/2018, and the closing stock price on that day was $5.925. Using the change in stock price and the dividend payment, calculate the implied effective dividend tax rate for firm XYZ. And the way that we'll set this up is we'll use our PQ minus our PX equal to 1 minus tau star D multiplied by that dividend. So when we solve for this, we'll be solving for the effective dividend tax rate for the firm. And hopefully through this example, you can observe that even though the firm paid a $2 dividend, the fall in firm value for the stock price was not $2. Signaling. In a perfect capital market, there are no information asymmetries. That means I know everything the managers know, and the managers know everything that I know. Obviously, that is not how the real world works. A manager of a firm will always have better knowledge about the firm than investors because the manager works there and is able to gather this information that's easy to observe, but might be really difficult to verify. We might not be able to go in and prove everything that the manager knows. For example, the manager might have better information about the firm's future prospects than the public. And that's something that might be really difficult to communicate to the public the degree to which the manager knows. Given that reality, how would a manager go about letting investors know that they're good prospects for the firm? It could simply tell investors all about it. Our firm is fantastic. We're going to do great. But we know talk is cheap. Or the manager could put their money where their mouth is and start paying out more dividends. We've got a ton of cash. We're confident things will continue to do well. So here, let me show you how much money I can put into your hands. The manager's goal is to reduce information asymmetry. The manager wants investors to share their confidence that the firm has plenty of cash coming in. So this will help maximize the firm's share price, and hopefully this confidence is well founded. Why? Because the manager should always be careful about paying a higher dividend because dividends are sticky. If a higher dividend is paid, and it's not the one-time special dividend like we saw with the example of Costco, trying to pay out more cash before the change in tax policy, then as an investor, I'm going to adjust my expectations and I'm going to expect at least that level of dividend from now on. So the manager has to commit to this higher dividend level. Managers like to maintain a long-term dividend to earnings ratio. So you're going to want to be confident when you increase it that the increase in earnings is also sustainable. If the increase in earnings that's needed in order to sustain an increase in dividends isn't there, then you're not going to be able to maintain that high dividend. Said differently, if I'm paying you a larger dividend today, you will expect me to pay you a larger dividend going forward. And if I can't maintain that, I'm going to have to cut it, which is the worst thing. Managers like to pay dividends that are smooth over time. They don't necessarily like paying a higher dividend with a higher earnings year because a single earnings year is not necessarily indicative of a new sustainable level of earnings. It could just be a fluke. So just because you had a good year doesn't mean you want to pay a bigger dividend unless it's a special dividend, because if you increase that dividend, at some point you may have to cut it, which you never want to do. Management also does not like cutting dividends. Investors interpret this as a drop in sustainable future earnings. This is really bad news to some investors who will immediately sell once the announcement of the dividend cut goes forward. If you want to cut dividends, you have excellent investment opportunities and need the investment capital, you better make it clear to your investors. So Royal Sun Alliance successfully did this back in 2001. They said, hey, we've got great investment opportunities, so we're going to cut the dividend. And in that example, the share price increased by 5% following the dividend cut. One of the things that sort of is important to remember is that when we talked about dividend policy being irrelevant, we always assumed that you were holding the investment policy fixed. So obviously, if you're using your free cash flow to invest in positive NPV projects, you're going to expect that firm value will increase. But again, remember, we're dealing in a world of incomplete information. So as a shareholder, I may have no idea that that's what you're doing. And I'll just assume, unless you tell me and you're credible, that all you're doing is cutting the dividend because you've mismanaged the firm and you can't sustain that same level of earnings for your payout ratio. Dividends are typically smooth, way smoother than earnings are. And hopefully you can see that from the graph. If you look at the historic level of earnings versus the forecast and dividends, you'll notice how that orange line is wavy, moving up and down, but the historic and the forecast for dividends, incredibly smooth. So we think of dividends as potentially signaling changes that reflect management's view about future long-term earning prospects for the firm. This is known as the dividend signaling hypothesis. This is why managers care more about dividend changes than dividend levels. Changes in the dividend convey information to the market, and this usually affects the stock price of the firm. While management typically knows more about the firm than investors, investors still have an approximate idea about long term earning prospects. So investors will often expect management to increase the dividend at regular intervals. If management fails to match investors' expectations by not raising dividends, then investors may interpret this as bad news about future earnings. So you hear this phrase quite often. Dividends or earnings fell short of analyst expectations, which again is typically bad news. Why? Because investors are expecting this increase in dividends. What if management surprises everybody and starts issuing a higher dividend? That is, it raises dividends higher than what investors expected. Well, you'll be super happy about this as an investor. You might revise your expectations. So you'll think this is great. Can the firm continue to do this going forward? Who knows? In summary, if dividends fall short of investors' expectations, as a disappointed investor, you will sell off the firm. And if dividends exceed investors' expectations, as an investor, you will now raise your expectations. So the solution probably best to always meet investors' expectations, which is really difficult to do. There's an article that's posted on Blackboard by one of the persons who wrote the irrelevance theorem, discussing in very easy to understand terms why the dividend policy will matter when we have market frictions. So this is an example of signaling. Hermes International of France, the France Luxury Group, said that its record margin and exceptional dividend last year isn't likely to be repeated in 2012, as it posted a 41% rise in net profit in 2011. The profit was gained from the sale of its stake in Jean Paul Gaultier. It would be imprudent to expect an identical operating margin in 2012, said the Hermes chief executive Patrick Thomas, after the company reported an operating margin of 31.2%, the highest since 1993. So, what's the big takeaway? When you have a massive increase in your earnings and you're trying to convey this information to investors, you have to be incredibly clear. And when you go up and down with the dividend, you're doing something risky as a manager, because when you raise it up, investors increase their expectations. And when you reduce the dividend, investors will typically take that as a very negative signal. So our last concern will be agency problems. As we just saw, dividend policy decisions become more complicated when we have taxes and information asymmetry, when we don't have complete information. Dividend policy decisions become even more complicated when we worry about managers being self-interested. This is called an agency problem, and that the person you hired might not be acting in your best interest. And it's really difficult to tell if this person isn't acting in your best interest. A firm often links managerial compensation to stock price performance. Therefore, if the manager knows more about future prospects of the firm than investors, she will issue a higher dividend to signal those prospects, thereby pushing the stock price upward and increasing her compensation. In theory, the incentives of the managers align with the incentives of the firm, who both want a higher stock price. However, if you're a large shareholder of a firm, you're going to be around for a much longer time than the manager. Therefore, the manager might only care about pushing up prices in the short term and make decisions that only improve short term performance without long term sustainability. For example, suppose a manager has a choice between investing in a long term positive NPV project or issuing a higher dividend. The manager plans to quit their job next week and will receive a compensation package tied to the share price when he leaves. Announcing the dividend will now push up prices. Investors might believe the good signal sent out by the dividend, even if it ultimately is a false signal. So if I know that I'm not going to be at this job for the duration of that positive NPV project, even though that long-term positive NPV project could be better for shareholders, I'm going to issue this dividend. Right, because I'm worried much more about the short term than the long term. So this is one of the ways that the agency problem can manifest itself. There are possible solutions around this. The firm could create an incentive contract for the manager. You could do clawbacks, for example. The base compensation could be the average of the stock price over a number of years. But the point is that we're really trying to figure out ways of dealing with potential bad behavior from a manager. When there is a large amount of excess cash, management should pay this out in the form of a dividend or a share repurchase. Otherwise, managers might start using this idle cash for negative NPV pet projects. So sometimes we refer to this as empire building. Some managers love to grow the firm by making ill-advised investments with free cash, and cash tends to be wasted when it's laying around. Alternatively, a manager might invest in a negative NPV project because it provides a private benefit. For example, a manager might be making a big case for getting a corporate jet. The corporate jet are often seen as negative NPV investments, but you can imagine that managers certainly enjoy getting around in them. So, in conclusion, we know that dividend policy can become relevant when we introduce frictions. Hopefully, you're aware of the dividend puzzle and you understand how taxes, information asymmetry, and agency problems can make dividends relevant.